Welcome to the Learning Corner, where we unravel the mysteries of investing. Today, we're diving into REITs. Have you ever thought about investing in REITs? It's a question that might have crossed your mind, especially if you're looking to diversify your investment portfolio. But before we delve into that, let's take a moment to understand broader landscape of investments. Investing can be a powerful tool for wealth creation. It's the art of putting your money to work, with the aim of increasing your financial resources over time. There are several avenues where you can invest your money. Of the most common ones are stocks, bonds, mutual funds, and real estate. Each of these options comes with its set of characteristics, benefits, and risks. Let's start with stocks. Investing stocks essentially means buying a share of ownership in a company. As the company grows and profits, so does the value of your investment. Bonds, on the other hand, are a form of debt investment. When you buy a bond, you're essentially lending your money to an organization, usually a government or a corporation, in exchange for periodic interest payments and the return of the original investment amount at the end of a specified term. Then we have mutual funds, a type of investment vehicle that pools money from many investors to invest in a diversified portfolio of stocks, bonds, or other assets. Mutual funds allow investors to gain exposure to a wide array of investments with a single purchase. And lastly, there's real estate, a tangible asset that can provide a steady income stream and potential appreciation over time. But what if there's a way to invest in real estate without the need to buy physical properties? This is where REITs, or real estate investment trusts, come into play. REITs allow individuals to invest in portfolios of large-scale properties the same way they invest in other industries, through the purchase of individual company stock. In short, REITs provide a way for the average investor to benefit from real estate investment without the need for a large amount of capital or the hassles of property management. So why should someone consider investing in REITs? Let's dive in. REITs, or real estate investment trusts, are companies that own or finance income-producing real estate. Think of them as a gateway, allowing anyone to invest in portfolios of real estate assets the same way they would invest in a company through buying shares of stock. Here's how REITs work. They operate under a unique business model, where most of their profits are distributed back to shareholders as dividends. This model is mandated by law. In fact, to qualify as a REIT, a company must return a minimum of 90% of its taxable income to shareholders. This unique setup provides a steady income stream for investors, which can be particularly attractive during times of economic uncertainty. REITs typically invest in a wide range of property types. This could include everything from shopping malls and office buildings to hospitals, hotels, and even data centers. This diversification across different types of real estate can help mitigate risk, as it's unlikely that all property types would be negatively affected by the same economic conditions at the same time. But what makes REITs truly special is their potential for long-term capital appreciation. While the steady stream of dividends is a definite perk, the real cherry on top is the possibility of the properties in the portfolio increasing in value over time. This means that in addition to the regular income from dividends, investors could also see a significant return on their investment when they decide to sell their shares. Investing in REITs also offers a level of simplicity and accessibility that direct real estate investment doesn't. There's no need to worry about the complexities of owning, managing, or financing properties. The REIT takes care of all that. All you need to do is buy shares, sit back, and watch your investment grow. Now that we know what REITs are, let's compare them with other investment options. When it comes to investing, it's always wise to consider all your options. So let's dive deep into a comparative analysis of REITs with other prevalent investment options such as stocks, bonds, and mutual funds. Starting with stocks, they have the potential for high return, but come with high volatility and risk. Stocks require a fair amount of knowledge and time to manage, and their performance can be influenced by a wide range of factors, from the overall economy to the specific actions of the company. Bonds, on the other hand, are often considered a safer bet. They provide steady income through interest payments, but their returns may not be as high as those of stocks or REITs. The risk with bonds is that if interest rates rise, the value of the bond can fall. Additionally, there's always the risk that the issuer could default. Then we have mutual funds, which are essentially a basket of various stocks, bonds, or other assets. They offer diversification, which can help mitigate risk, but they also come with management fees. Returns can vary widely based on the specific assets in the fund. Now let's turn our attention to REITs. REITs stand out in this crowd for a few reasons. They offer a balance of income and growth, which can be attractive to many investors. Like bonds, REITs can provide a steady stream of income through dividends. But unlike bonds, they also have the potential for capital appreciation. Much like stocks, REITs are required by law to distribute at least 90% of their taxable income to shareholders as dividends, which can make them a great option for income-focused investors. Plus, because they're traded on major exchanges, they offer the liquidity that direct real estate investment lacks. In terms of risk, while REITs are affected by the same market forces that influence stocks and bonds, they also have unique risk factors related to the real estate market. However, they offer the advantage of diversification, as they spread their investments across multiple properties, and often across different types of real estate. In the end, the best investment option for you depends on your individual financial goals, risk tolerance, and investment horizon. Stocks might be more suitable for risk-tolerant investors seeking high returns, while bonds could be a better fit for conservative investors looking for steady income. Mutual funds offer a mix of assets, and REITs provide a unique combination of income and growth potential. As we can see, REITs can offer a unique blend of benefits compared to other investment options. They provide the potential for both income and growth, offer liquidity and diversification, and serve as a viable option for those seeking exposure to the real estate market without the need to directly own property. It's no wonder that REITs are becoming an increasingly popular choice among savvy investors. So why should you consider investing in REITs? Let's dive right into the reasons. One of the primary advantages of REITs is their potential for high dividends. REITs by law must distribute at least 90% of their taxable income to shareholders annually. This requirement often results in higher dividends compared to other investments, making them particularly attractive to income-focused investors. The second reason to consider REITs is diversification. Investment diversification is a strategy that can help manage risk by spreading investments across various financial instruments, industries, and other categories. It aims to maximize returns by investing in different areas that would each react differently to the same event. REITs can be a valuable addition to a diversified portfolio because real estate often reacts differently to economic events compared to stocks and bonds. Thirdly, REITs provide access to real estate investments without the need to buy property directly. Investing in real estate can be costly, time-consuming, and requires a significant amount of expertise. However, REITs offer a way to invest in real estate without the need to purchase or manage properties yourself. This makes REITs a convenient option for those who want to add real estate to their portfolio but lack the resources or desire to deal with physical properties. Moreover, REITs offer liquidity, a feature not commonly associated with real estate investments. Unlike physical properties that may take months or even years to sell, REIT shares can be bought or sold on an exchange at any time, just like stocks. This liquidity makes REITs a more flexible investment option compared to direct real estate ownership. Finally, investing in REITs can also provide tax advantages. The dividends received from a REIT are taxed as ordinary income, not at the lower qualified dividend rate. However, a portion of the dividends may be considered a non-taxable return of capital, potentially lowering your overall tax liability. In conclusion, REITs can be a valuable addition to an investment portfolio. With their potential for high dividends, diversification benefits, accessibility, liquidity, and potential tax advantages, REITs present an attractive investment option for a wide range of investors. So, let's quickly summarize what we have discussed today. We started by exploring the vast landscape of investment options, and then we dove into the world of real estate investment trusts, or REITs. These are companies that own, operate, or finance income-producing real estate, providing an opportunity for individuals to invest in portfolios of large-scale properties. We compared REITs with other investment options, discussing the advantages and potential risks associated with each. REITs stood out due to their unique combination of regular income streams, long-term capital appreciation, and diversification benefits. We then delved into why one might consider investing in REITs. The key takeaways? REITs offer potential for high dividends, provide a tangible asset that can appreciate over time, and allow access to real estate market without the need to buy property directly. Whether you're an experienced investor or just getting started, considering all your options, including REITs, can help you build a diversified and potentially profitable portfolio.